You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast, coming to you from Montecito, California. Before I begin, I have a big announcement, okay? This announcement, I've sort of alluded to it in past episodes, but I'm launching a new podcast. Wealth Formula is not going anywhere, don't worry. But you see, I have other interests as well. And I spend a lot of time on things like reading about longevity medicine and things like that. And I've been doing that kind of thing for a while. And it occurred to me that I think I should share it with you. So rather than just, read and get interested in all this stuff by myself, I am launching a new podcast, and it's called Sapio. That's SAPIO with Buck Joffrey. That podcast, when you listen to this podcast, should be live. So please make sure you check it out, download it. It'll be on wherever you normally find your podcast. That's where you're going to find it. If you find us on YouTube, it will be on YouTube. You find us on iTunes or Stitcher or whatever. But check it out, because I think this is the type of podcast I think you're really gonna enjoy, because of course at the end of the day we're in this podcast with Wealth Formula, we're interested in how to make money and create freedom and things like that. But there's another part to life, which is about living a long, healthy life, trying to learn new things and try to optimize the time that we have on Earth. And that's what Sapio is about. So there is a lot of, it's sort of a hand-in-hand type thing with Wealth Formula for me. And I would love for you to listen to it. The first several episodes are on what we're calling the pillars of longevity. And there's some crazy, really good stuff that you probably never heard about when it comes to longevity science and the potential for, living an awful long time, more than you could have ever, much longer than you would imagine today, and live it as if you're much younger than you actually are. So check that out. Again, Sapio with Buck Joffrey, available widely. Now today, I am going to, on Wealth Formula, talk a little bit about this craziness in this troubled economy that we're having and that kind of thing. And it brings me back to, my own medical days because, of course, as you probably know, part of why I'm interested in all this longevity and stuff is because I'm a physician. I started out as a neurosurgery resident, moved over to Otolaryngology, head and neck surgery. That's a mouthful, I know, and then did some facial plastics and cosmetics surgery training as well. And so, during my training, it didn't really matter how much I worked. I would always get paid the same paycheck. Right? Now, I wasn't lazy, but I certainly didn't enjoy working for what amounted to minimum wage. And so I wasn't about to volunteer for extra call or do anything like that. I mean, I was already overworked and, not super motivated to go try to work a lot more than I already was. But eventually I did finish training, and I was hired, oddly enough, by a facelift company. It was a high volume company that would recruit patients with, I would say maybe some questionable marketing tactics. And they would hire an army of young surgeons, good surgeons from good residency programs, and get them into the program and put them to work. Right. And so for the surgeons like me, it was like a great opportunity. You get tons of experience and, you get paid a lot more than you did in residency. I got paid about what it ended up being about 15% on revenue that I generated for the company. Now, they didn't charge as much as a typical, Beverly Hills facelift surgeon or something like that, but I was doing 3 to 4 facelifts a day, and 15%, well, it turned out to be really, really good money. I mean, for me, at least at that time, for reference, my most recent job before that, I was making about $50,000 per year in the city of San Francisco, which puts you right around the poverty line. So anyway, I remember the day I became a capitalist. Okay. And it was the day I got my first, what I would call my real paycheck. It was, my big boy paycheck. And in that 2 weeks, I made more money. Of course, there was a bunch of tax and stuff too, but like grossly, I made more money than my entire surgical internship year. And that completely blew my mind. And suddenly I realized that the harder I worked, the more money I could make. And that actually conceptually was brand new for me. That was brand new because I'd always been on sort of a salary, a slave salary as a resident and that kind of thing. So I really, this concept just blew my mind. And that made me work really hard. And suddenly I was more than happy to put in the long hours, come in on the weekends. I enjoyed doing procedures too, and I was good at it, but I liked the idea that the more I worked, the more money I made, and it was making me super duper happy. And, not only like, and when I mean happy, I really do mean happy too. Like it was a noticeable change in my spirit. Even though I didn't own the business itself, I really cared about it. I wanted to make sure we did a good job. We had a good reputation, and in a sense, I took ownership, even though I didn't own the place. And that's important because after all, in the history of the world, no one ever took a rental car to the car wash, right? So anyway, of course, like all entrepreneurs, I ended up eventually realizing that was an even better way to make money than getting paid for the amount of work that you do, and that is to own your own business. And I wanted to start on multiple businesses, and the rest is, of course, history. But the moral of the story is that the opportunity for those of us who have talent and who work hard is endless in our country, and getting paid for the first time gave me my first taste of that. And anything, in my opinion, that threatens that reward system of hard work and being rewarded for that threatens the very core spirit of who we are in this country. I really, really believe that. And of course, not everyone shares my views, especially these days. And it's not always as simple as perhaps I make it sound, right? And we still need to take care of people in need. We still need to provide opportunity for the underprivileged so we don't leave them behind. And this became even more evident during COVID when people simply couldn't work. But I fear some of the remedies of a difficult time have permanently altered our culture. After all, it is difficult to take things away from people after you give it to them. And sometimes, that you just go into this cycle, basically, where it becomes more and more, the government becomes more and more sort of socialist every day, right? Now, my guest on Wealth Formula podcast today was right in the middle of the policy-making decisions that were made during COVID, and especially those that affected people like us, when it came to rent forbearance and how to treat landlords and all that kind of thing. And what makes his perspective interesting is that he is a libertarian guy who works for a libertarian think tank, the Cato Institute. So when we come back, find out how a small government guy navigated the biggest government intervention in American history, and also find out what he thinks of today's economy and various policies that are coming through the Biden administration. We'll have all that right after these messages. Welcome back to the show, everyone. Today, my guest on Wealth Formula podcast is Mark Calabria. Mark is the senior advisor to the Cato Institute and co-founder of the Cato Center for Monetary and Financial Alternatives. He provides strategic input and direction on the federal economic policymaking process. He's also a former director of the Federal Housing Finance Agency, which regulates and supervises Fannie Mae, Freddie Mac, and the Federal Home Loan Banks. He is the author of Shelter from the Storm, How a COVID Mortgage Meltdown Was Averted. Mark, welcome to the podcast. Thanks for joining us.
Buck, it's great to be here.
So, your background is interesting. And for those people who don't know, tell us a little bit about the Cato Institute.
So the Cato Institute is a think tank. And again, you can kind of think about think tanks as academics who don't teach and generally share a point on the political spectrum, a broad point of view. So Cato, founded in 1977 in the Bay Area of San Francisco, moved in the early 80s to Washington, D.C. He's generally considered libertarianish. So there are issues in where we agree with the left. There are issues we agree on the right. And we tend to be very nonpartisan about it and tend to, really call out things we disagree with and call out things we agree with. But again, we work in a broad set of policy issues. I'm in more the economic space, but we at Cato do work on immigration, criminal justice. I mean, pretty much, healthcare reform, everything under the sun that has a policy angle. And should say we don't take any government money. We are 100% supported by kind contributions from people who share our philosophy and want to see us change the world.
That's great. And obviously from your perspective, your focus is a lot of it has been on mortgages and things like, financial markets that way. I'm curious, there's a recent article that I saw in the Wall Street Journal regarding this concept of upside down mortgage policies. I think this is going to be kind of a surprise to people. Like, do you want to tell us what this is? Because this is like essentially a new law, right? It's not something that's being discussed. It's real.
Well, it's a new pricing. So, and as you touched upon, I've spent a lot of my professional career in the financial services space, particularly mortgage. What was the primary regulator for the mortgage market during COVID? And since about the 1980s, pre-1980s, it was really the case that everybody kind of paid the same for a mortgage. But if you were a higher risk, you didn't really get a mortgage, or you got it from a hard money lender, or you got it from the seller. Like, the typical going to a bank. Again, if you were a marginal credit, you simply didn't get a loan then. So starting in about the 80s, we had the development of risk-based pricing, largely because of the creation of the credit rating agencies and other things. And so you developed over time a system where if you were a lower risk, that is, like you had a higher FICO, or you were able to put a lower down, bigger down payment down, you paid a lower rate. And again, over time, that really started to reflect tightly. And again, the flip side of that, of course, is if you're high risk and you have a low FICO and you're putting very little down, you tended to pay a higher rate. And again, we've seen the financial markets kind of gravitate in that way. And of course, it's not just mortgages. That's true in auto, credit card, other lines of credit as well.
By the way, that makes a lot of sense, right? Basically, from the lending side, you're de-risking, the opportunity for the lender here, and you should be paying less if you're providing them less risk. So that makes sense.
100%. I would also argue from the borrower side. I mean, I understand that nobody likes to have to pay a higher rate. But first of all, prices convey information. And if you are going for a loan of some sort and it's a high rate, that's information about perhaps your own financial situation.
Right.
In many instances, you can 6-12 months make considerable progress on your credit history if you work on fixing it. Right. So to me, if the market's charging you a high rate to borrow, that's the market's telling you something. Perhaps you should listen. Yeah. So that's one factor. And the other factor is, as I mentioned earlier, before the advent of risk-based pricing, higher risk borrowers simply just didn't get mortgages. And so it's increased access.
Right.
So we can debate whether paying a higher rate and getting a mortgage is better than not being able to get a mortgage at any rate. Personally, I think it is. But it's increased access. So I think it's a win-win. Now, what the Biden administration has proposed doing is using their control of Fannie and Freddie to kind of flatten that relationship between what you pay and the risk. Now, there'll still be a connection between if you're better risk, you'll get a better rate, but they're really trying to flatten that to create more of a cross subsidy. So they are trying to essentially make you the better borrower pay more to somewhat subsidize the lower borrower. But I do want to be very clear. This is in no way suggests you should stop paying your bills and ruin your credit because you think you'll get a better mortgage rate. You won't. So you should still work at your credit and do those things. But it is very much geared to be, cross subsidy within the system. Only applies in the Fannie and Freddie space. So
to be clear, though, Mark, to be clear, you're saying that if you so the stratification here is based on purely on a credit score?
Yes. And again, it's important to remember part of the argument from the Biden administration that this is meant to help low-income folks, but let's make two observations important. First of all, it's only the Fannie Freddie space. So if you're in the jumbo, if you're truly rich, this isn't affecting you because you're not in the Fannie and Freddie space. And then it may surprise some folks, but I think you probably know this well, Buck. While the relationship between a person's income and credit is positive, it's actually quite weak. There are a lot of well-off people who don't pay their bills on a timely basis, and there are lots of poor people who actually do pay their bills on a timely basis. So even if you, as a social policy, feel like, well, let's do something to help the less off, this isn't what it is. It actually, and again, most of poor households are likely to be renters. This is really, in a sense, a cross-subsidy within the middle class between those who have better credit, and it taken years to build that, and those who have weaker credit. I should also note, one of the biggest connections between your credit is your age. And, it's not, fair to say when many of us were in our 20s, perhaps we weren't as responsible as we were later in life. And, it often takes years to build up a good credit score. So this is, in a sense, a subsidy from those in their 40s and 50s to those in their 20s and 30s.
Yeah, and the credit thing is really interesting to me in general because after a certain point too, it becomes a lot less important. Like I know in my case, my credit is not perfect at all, and I don't know exactly why. Like I'm maybe just a little bit over 700 or something like that. So when I was buying, I was getting a few mortgages around here, and I have a lot of real estate debt, tons of real estate, and I suspect that's part of what it is. But when I went to a private bank that I get my mortgage from, they didn't really even care what my credit report said. That was not part of their, that wasn't.
You raise a great point, which is that credit scores are important, but they are not the end all be all.
Right.
And again, perhaps the biggest takeaway from this change is, for better credit borrowers, there's going to be a bigger difference in rates. So this only affects Fannie and Freddie borrowers. Right. A lot of higher income, but not necessarily rich borrowers, the bank wants that loan. So if you're getting a mortgage for, say, $700,000-$800,000, often the bank will want that relationship, and they'll want to keep that loan on their books, and they'll give you a better deal than if it was sold to Fannie and Freddie. So the most important takeaway for folks is that this makes it all the more important to shop for rates because it'll be bigger diversion. And again, if the bank has a bigger distribution, if the bank has an existing relationship with you, they try to take that holistically. So in your case, if you've got all these other deals with the bank, I'd rather you've got loans and you're doing business and they want to keep the relationship, they might look at it and say, well, okay, the overall relationship is important. It's also obviously important to keep in mind that, the bigger down payment. So before there was a real growth in Fannie and Freddie subprime, if you go back to kind of what subprime looked like in the 1990s, if you had a 660, 680 FICO, you would get a loan and they would require you to have like 30-40% down. So there are other offsets there that can factor into it. So yeah, your credit's important. It's good to have good credit. It tends to be more buckets, if you will. I'm not saying you shouldn't strive to have that 850, but if you've got 780, 800, it's fairly similar. There may be some differences in some loan products, but again, a lot of other factors. But it's a smart thing to do to try to keep the best credit you can. I wouldn't necessarily worry about it on a month-to-month basis, but if you are applying for a rate, having prime credit is extremely helpful.
So let's go to a different topic. You were at once the Federal Housing Finance Agency director. When you were, how did you determine that rent forbearance was the right policy during the pandemic? And I guess the follow-up on that is, are you satisfied with what was achieved from that?
Well, it's one of the reasons to write the book, is I felt very strongly about trying to tell the story of not only where I thought we were successful, but where we were constrained and perhaps in some areas fell short. And I should clarify, later in the summer of 2020 was when the CDC invoked their eviction moratorium. We didn't have anything to do with that. in March of 2020, we initially saw that only about, and again, remember, from about February to May, we lost 22 million jobs. So shockingly quick and deep job loss. But the thing that we immediately saw in our data was only about 40% of those people losing their jobs had mortgages. And of course, this is not surprising. We all remember bars, restaurants, and other things. So we saw immediately that renters were being most impacted. So because we didn't have a way to mandate it, what we essentially set up was a system where the landlord, because again, keep in mind, I'm running Fannie and Freddie. I have information on the mortgage. I have information on who holds the mortgage. We don't even know whether the unit's occupied, to be frank. All we know is this is a rental unit with a mortgage on it. And so we set up a system where the landlord could agree to not evict for non-payment. Of course, they could evict for nuisance and all the other legitimate things beside that. And then we would give them a pause on their mortgage. Now, the reasons why I say there's some limitations to this, between us and FHA, which is also obviously a big landlord, not only public housing, but multifamily, maybe we got about 40% of the rental market. Some of this, of course, is, it's easy to think about big high rises when you think rental, but half of renters live in units in properties with under 5 units. Most renters live actually in like a third of renters, single family housing. A surprisingly large number of renting households have the rental property has no mortgage on it. And if there's no mortgage, we had no way to offer assistance. So on one hand, I thought we were very effective in the small part of the market in which we had an influence.
Well, I think, I was kind of getting at that a little bit. Our group, we deal in larger apartment complexes, a lot of Freddie Fannie stuff. And there wasn't really a whole lot of relief for landlords in those situations, right? It was a forbearance type thing. And then the landlords were kind of like, and the investors were kind of like, out to dry and try to figure out what to do about it. And I'm just curious on the justification on that.
It was a very tough situation, and I had, only one. So I had a single rental property for much of COVID myself and lost a fair amount of COVID rent from one of the tenants who lost their job. And they eventually moved out, and I ate it. I mean, it sucked, but it was the situation. And, later Congress, of course, provided assistance directly to landlords could apply for, but that was pretty late in the game, not till I think 2021. And even that, it was so bureaucratic. So the truth is most landlords ate that. And again, while on the homeowner side, most people who took COVID forbearance, as I talk about in the book, had a lot of equity. We structured the forbearance in a way that they were incentivized to pay it back. But it was very different with tenants. We didn't have a direct relationship with the tenants. We had no way to penalize anybody who took 6 months and didn't pay their rent and left. And there was a lot of that. So I'd be the first to say, I think this was a situation that was extremely unfair to landlords. That's why we made, unlike the CDC moratorium, what we did, we made voluntary. But we also had no ability, the most we could do is give the landlord a break time-wise on the mortgage, because we had no ability to just forgive it. Obviously, if there were going to be landlords who were stressed, we would work with them to try to work out a modification plan. But ultimately, we at FHFA, overseeing Fannie and Freddie, had no way to make the landlords whole. And I think that was a real tension and stress point during the crisis.
Yeah, no, I get it. I mean, there wasn't really any great solutions to, a truly unusual situation like that. And
I really, I guess this way, I worry that particularly 2020, but we've seen this broader trend, in the public of demonizing landlords. And, personally, I don't think there's a better, it's a noble thing to provide shelter for somebody else, and I think it's a great profession. It's a hard profession. And I don't think policymakers appreciate how difficult it is to be a landlord, and you get very little sympathy. And I wish we could have done more, but we were in our own box, if you will.
Well, at least we get the tax benefit.
That's true. At least.
Shift gears a little bit here and talk a little bit about the bank failures, and maybe more specifically the bailouts. And again, I'm looking at this from your perspective as, as a libertarian, and the outcome of this in the long term and the implications of all of this, frankly. I mean, even going back to our discussion here of, essentially demonizing owners and not providing anything, any support for them in the large apartment building space, and then going here and, and then the banks have these bailouts that, we've had FDIC protections and all that kind of thing for years and years. And the next thing you know, it's actually challenged, and boom, you change the law. So tell me what do you think of all this?
I'm extremely frustrated with the response. And, one of the things you may recall, and I know this will probably a little weeds for COVID, but in 2020, there were big calls to have government assist mortgage servicers because of some of the assistance that was provided. And I walk through in the book, what it's like to be in the hot seat of getting 99% of the phone calls you're getting to rescue companies and bailouts. And of course, there were lots of industries, airlines, others, cruise ships that got bailouts in 2020. So one of the reasons I write the book was I wanted to convey to the public, what it's like to be the recipient of demands for bailouts. Personally, I still don't think that while we're still getting information that the Silicon Valley Bank rescue of the depositors was justified. I don't think it's systemically important. It's not a big bank. Obviously, it's an important bank for Silicon Valley, but the uninsured depositors would have gotten 90 cents on the dollar, which to me, I understand who wants to take a haircut, but you have to have that market discipline. I thought the initial messaging on the part of the administration was muddled. You didn't know from day to day whose deposits and what banks were covered. So to their credit, the First Republic assistance was done better, if not perfect, or not well, because the cost of it still looks extremely high. So I do worry that, we have set out a standard where, if you've got deposits over 250, are they covered by the government or are they not? And those have to depend on what bank they're in. And I very much worry that, people are going to look at this and say, I'm much better off if I've got big deposits having it with Chase or Bank of America than I am with a community bank. And one of the reasons this concerns me, of course, is the community banks and the regional banks are incredibly important sources of small business lending. They're important, as you know from being a physician, if you're not going to go to Chase necessarily for your loan to start your doctor's office, you're going to go to community regional bank. And they're also important sources of construction lending. So I worry that part of this consolidation that this will drive is going to make it harder to get certain types of lending. So as a policy matter, I worry about what it does to the structure of the banking industry. Obviously, this is probably a contrarian view, but I think the uninsured depositors pulling their money out of Silicon Valley Bank did us a favor, because judging from the reports and the research was done, it would have taken the regulators another 6-12 months to do anything. And the hole would have been deeper and it would have been worse. So to me, having uninsured depositors force the closure of a bank that the regulators should have been closing already is generally a good thing. And I think we need more market discipline, not less. The Fed and the FDIC have all done kind of after action reports, and it's not pretty. It really is. I guess I'd put it this way, for an investor's perspective, if you don't have strong faith in the management of a bank, then you should have nothing to do with that bank, because the regulators are not going to address it on a timely basis. So, and the reason, I guess I'd almost put it this way, the kind of regulatory failures we saw at Silicon Valley Bank by the Fed are more the norm than they are the exception. And you should never necessarily, I guess, roundabout way of saying, don't trust the government to do your due diligence for you, because they're not going to do it well.
The party line, literally the party line, right? Yellen, Powell, Biden, they're insisting that the banking system it's sound, right? I'm curious on your take on that, because to me, obviously, and maybe this is stratified in terms of the community banks and the big banks and all that. But what's your take?
Well, first, let's note what seems to be at a minimum a tension, if not a contradiction, which is They tell us on one hand the system is fine and sound, but they also tell us the system can't withstand uninsured depositors at Silicon Valley Bank taking a 10% haircut. So,
Right.
I mean, which
Right.
is it? If the system can't take that, then it's probably not fine and safe. So they kind of need to make their choice. Personally, I think, the way they look at this is Silicon Valley Bank had about half a dozen serious problems or serious vulnerabilities. Your typical bank, your typical regional small bank has one or two of those. Like a lot of banks have treasuries and Fannie and Freddie securities that they haven't fully perfectly hedged against and are going to take losses on. So at this point, I would say I'm expecting 4 or 5 more regional banks to get in trouble and to perhaps even fail in even fact or at least the reality of it. But that said, I think it is concentrated in a handful of banks. This isn't a problem where the entire system, like you think back to the savings and loan crisis in the 80s, you were at points where that entire industry was insolvent economically. That's not the case with the banking industry today. You have important but not systemically overwhelming chunks that are in trouble. And my view is I think you need to deal with those institutions directly. You get this argument from the administration that there's contagion. It's not really contagion. It's the fact that you've got some of these institutions that are functionally insolvent and investors are waking up to it. You also have the situation where, in the year or so leading up to the failure of Silicon Valley Bank, there are about $800 billion in deposits taken out of the system. That's not surprising because the banking system during the pandemic grew by $5 trillion in deposits on a base of 13 trillion. And, when people were getting zero for their alternatives, then maybe that was acceptable. But in a world where you can get 4 or 5% on 3-month T-bills, you're going to leave that in a deposit? So I guess in one way is I expect over the next 12 months to at least another trillion in deposits leave the banking system for no other reason than you've got much better alternatives, whether it's mutual funds or whether it's T-bills directly. And that's going to put stress on some banks, but it's not going to be enough to sink the system. It will be enough to sink, again, another 4 or 5.
Right. And that also has, I guess, confidence implications as well. Right. Yeah. And then we're talking about, almost certainly significantly compromised lending environment for small business and all of this. And so in effect, there is a little bit of contagion in terms of what the net result is on the economy, presumably.
There's an impact. I mean, I've never been, I know it's a commonly used term. I feel like contagion just assumes that Silicon Valley Bank sneezes and everybody else catches it, where I think it's a little more nuanced than that. First of all, we're already seeing the regulators clamp down in response. So there's nothing like a bank failure to make the regulators feel embarrassed that they weren't doing their jobs. And of course, their response to being embarrassed about not doing their jobs is to clamp down on lending. And you're particularly going to see this. Remember, Signature Bank in New York was one of the more important multifamily commercial real estate lenders there, as well as a little bit in the crypto space. And you're certainly seeing already bank regulators clamp down on commercial real estate. So getting construction lending, getting apartment lending. And you were obviously at a point in the cycle, my view is the apartment sector writ large is already going to be overbuilt. But that said, it's going to get tougher to get construction lending, small business lending in many institutions because of the regulators, in some sense, overreacting. But all that said, that's one part of it. Certainly, I kind of describe it this way, and I'm sure you run into this a lot. As I mentioned, the spreads between alternative investments and deposits have been widening for some time now. And many of us, tell ourselves for sometimes days, weeks, months on end, I'm going to rebalance my portfolio at some point. And then, you take a while to do that. And then all of a sudden there's a shock like this and you're just sort of like, okay, today's the day I'm really going to do it.
Yeah.
And so I think you're certainly going to see a stress, like I mentioned, you're going to see at least $1 trillion in deposits leave the system. That's going to put stress, particularly on regionals and small banks. Some of them are going to do fine, but again, it's going to be tougher to get credit. Certainly it changes the pessimism. People are, despite that we've still continue to have, strong enough job growth, I mean, obviously, I think people are getting much more pessimistic about the economy, and that hits, your willingness to want to invest and start a business and many things. So I do think that these events, are putting a damper in. You need to be cautious of numbers that are pre-bank failure. So, for instance, a lot of the, real estate, the single family sales numbers from February were strong, but they were before these bank failures. And so are we starting to see that put a drag on the market? So what I would say is you got to pay attention to the next 2 months worth of data to really figure out, are we going to be lucky and have a soft landing, or is this going to be a hard landing? And I think it's just too early to tell. But, it's also a reminder, some of the best investments are made in the bottom of the market. If you're the person sitting there with liquidity, and you can be a provider and seller of liquidity in a stress environment, you can do quite well. And I would argue that's kind of the Warren Buffett model. And that's, he waits around for 5 years or so for everybody else to mess up, and then comes in and provides the floor. That's a great investment strategy if you've got the patience and liquidity for it.
Yeah. What do you think's, one of the things that we're kind of watching is in certainly apartment building sector, things are at a snail's pace. I mean, there's virtually like zero market, right? Very little liquidity in this market right now. And a lot of that is because of the lending environment and, Freddie Fannie kind of debt that we're usually typically looking at in that. It's dried up pretty well in terms of, or made the requirements have been very stringent. What do you think? You think that's going to loosen up anytime soon, or what?
It'll be at least 6 to 12 months, and I would say we are in the second or third inning of this game in terms of multifamily correction. And I hate to put it this way, but it's going to get worse before it gets better.
Sure.
And we've been building apartments at a higher rate than we have since like the 80s. And so tremendous amount of apartment construction. A big difference between now and then is a huge amount of it is subsidized. I mean, something like a third to half is typically tax credit properties, and then there's a lot of local subsidies involved. The importance of that, one importance of that is it takes it longer for that ship to turn, because once you've gotten all these subsidies and you've gone through all the approval process, you're going to finish that and you're going to open it up regardless of whether it covers its costs or whether you're going to be able to have the high level absorption of the properties. So I think we've got a lot of inventory coming online in the apartment market. I would probably be someone who'd want to be a net seller right now, but in 12 months, you're going to get to a spot where perhaps it's wise to come back into that market as an investor. Of course, as our realtor friends tell us, location, location, location. So for instance, I mean, New York is a very different market multifamily than say, Sacramento. And of course, we're also in the bizarre world of the California real estate's taking a beating while Florida real estate's doing well. Yeah. So, you really have to, I'm not going to quite say that we've abandoned having some sort of national convergence or similarities or core aspects to it. But this is one of those things where what's going on out west is very different from what's going on in the southeast. And so you have to be aware of local market conditions, because at the end of the day, I mean, the fundamentals for real estate are demographics and income. Is the population growing in that area? And, I think after prices reset, which will be painful for California, you'll start to stabilize. But a lot of people moved out of California during the pandemic. A lot of people were, stretched in terms of affordability. And until that really resets and until you get a little more construction going there, prices just aren't sustainable rents aren't sustainable relative to where incomes are in California. So you're going to continue. We've seen a painful correction there. We're going to continue to see that. But again, I would really emphasize for those who really kind of want to be in the real estate game, there are markets of opportunity. You just need to do a lot of research and appreciate that. Miami is not, it's not Los Angeles, and there's very big differences.
I guess the last topic I want to touch on is inflation. So is the Fed on track to kill inflation? I think they've turned a corner, and it's been painful. Let me be very clear. They were so behind the curve. I mean, I'm of the view
that they really should have started, normalizing in the second half of 2020. I mean, what we saw that summer in June, July was just such a dramatic job recovery. So there really wasn't a rationale for the kind of liquidity Fed was pumping in the system later part of 2020. But, we are where we are. I mean, I only raised that to say the best way to deal with these situations is not to get into them to begin with. But again, here we are. So Powell has been very aggressive. I actually talk a little bit about in the book how I was involved in his initial selection and some of the pros and cons I saw in that. If people want a little bit of Washington insider take in some of the book, we've seen a contraction in the money supply. We're starting to see a contraction in lending, partly because of the regulatory response. So that said, I still think it will be 2025 until we're near the Fed's 2% target. And so we're going to be, the worst of inflation is behind us, but we've still got some painful inflation ahead of us. It's just.
You think they're going to keep being hawkish? I mean, they actually kind of took their foot off the pedal in the last.
Yeah, a little bit. And, first keep in mind, despite what the Fed might want you to believe, they are a deeply political organization. So perhaps a little backwards induction here.
There's a presidential election coming up too. Right?
Exactly what I was going to say.
Right.
So, it would have to be pretty bad on the current pace we're on. The Fed will not raise rates, nor will they likely lower rates next year in 2024 because of the presidential election. And in fact, I would go as far to say, come the November, December meetings this year, they're going to be very hesitant to move. So my prediction would be that I think the last window for a rate increase is the September meeting. They may just stand pat then, but I think because we really need to start to see some changes, and the strength of the job market really suggests to me that we've got at least one more rate increase coming. So I don't think we're done. And in fact, again, I think the last increase will be a quarter point in either July or September. And then I think they'll be done until after the election. That's, of course, contingent on things not going sideways in a big way. If we are in a deep recession, 2024, they'll cut rates. But if we're kind of on the slow landing, inflation moderating, jobs moderating, but still positive, then again, July, September is my expectation of last increase.
Good stuff. Now, the book, Mark, again, is Shelter from the Storm, How a COVID Mortgage Meltdown Was Averted. Tell us a little bit about that. I mean, obviously, it sounds fairly self-explanatory.
I thought it would be. The core of it is somewhat self-explanatory because, the core story is kind of how so I should roll it back and say I was on the Senate Banking Committee in 2008, and I was of the view that much of the response to the mortgage crisis in 2008 was poorly handled, so to be frank about it. And so part of the narrative of the book is how I looked at how poorly handled things were in 2008. And then as fate would have it, I happened to be the person in that seat in 2020. And I talk about in the book why we did it differently than 2008. And I walk through kind of the decisions, the trade-offs, the uncertainties, and why I think it turned out much better. Now, there are other aspects of it. We talked earlier about the rental issues. One aspect that I thought was incredibly important when we were setting up forbearance programs was we wanted to make sure they didn't punish people to go back to work. And so one of the problems in 2008 was you would lose a lot of your mortgage forbearance if you started working. And so we wanted to make sure we had a program that didn't punish work. And that's talked about in the book. There's some, again, I mentioned, why we said no to bailouts and some of the mortgage industry and kind of the ins and outs on that. I give some leadership lessons, on terms of coming into a very troubled agency and give a background on that, how we kind of turned that around. And of course, a few insider stories here and there. So for those who are just kind of interested in what it's like to try to guide an agency in a mortgage market through a crisis, I just wanted to put that out there and let people know why we made certain decisions in some way. So I think it's a fun read, little stories and anecdotes here and there, as well as probably more than you ever wanted to know about the mortgage market.
Great. Mark, thanks so much for being on Wealth Formula Podcast.
Buck, it's been a pleasure.
We'll be right back. Welcome back to the show, everyone. Hope you enjoyed it. It is interesting to me how a big government intervention like that happened, and guys who are even libertarians like our guest were essentially seeing that we had to intervene in a big way. But anyway, the rest is history right now, right? So anyway, grab his book. It might be an interesting read to figure out how all those decisions were made. Before I go, I want to remind you again, I have a new podcast, and it's going to be a lot of fun. I think you're going to enjoy it. It's called Sapio, S-A-P-I-O, with Buck Joffrey. And it is going to be about all sorts of interesting things with a big focus on longevity medicine and other health related stuff. Check that out. Make sure you download it, subscribe, give me a review if you like it, because it's hard to start a new podcast. Anyway, I appreciate your support. This is Buck Joffrey with Wealth Formula Podcast, signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.